Hey everybody, Matt Johnson here from Primary Vision Network. Thanks for joining us for this week's Frac Spread Count show for the week ending Friday, July 21st. Mark Rosano is called away to a meeting in Washington, D.C., so once again, jumping in the saddle here for a free version of the Frac Spread Count show to get you an update and also share some additional information about the frac market. So let's get started. And here we are. The frac spread count for the week ending July 21st is 274. This is an increase of almost 4% from last week and in line with seasonality for the last few years. I know that there's been some rumors and, circling about the frac market feeling a little bit of a decline. And, we've seen the first set of earnings coming out too, and it seems to be with the rig count, which, by the way, this week did go down again, that operators are focusing on completions and maybe taking a little bit of the risk off the table for their drilling profiles. And then maybe in Q3, we'll start to see the decline in completions. But for now, we're really seeing just kind of normal volatility, up and down a handful of percent, some rotation of equipment still happening. Obviously, there's been a little bit of subjectivity in the weather out there too. So, seeing some of these, really super high temperatures, we're thinking that some of these spreads have gone from 24 to 12 hours or potentially, there's been some issues. So we're seeing this up and down that's going to float through the end of July. And as we get into August, we're probably going to start to see us get to a peak because we think operators in September will make that choice to say, you know what, we're just going to opt out of completing those additional wells. And, also we're seeing the DUC inventory start to dry up a little bit. Once again, DUCs represent the drilled yet uncompleted wells. However, at this point, there's really no cause for concern. A long-term outlook looks like we're going to have less wells to frac, but the short term, we still have a busy profile with at least 8 or 9 weeks of frac jobs available. So, good news on that front. We're going to have a positive week this week to take away from us, and we'll move into August and probably see the peak for potentially the next few months. But this is all in line with our forecast, all in line with seasonality and the trends of the summer. However, with weather and instability in the market with inflation and rates, and of course that looming potential of a recession has us for a little bit more cause for concern for the fall month. So we'll keep our eye on it, but for the week ending of July 21st, 274 is the frac spread count. Moving ahead, we just want to share a couple things that we've shared recently, and man, we've done it's got to be 10 or 20 different webinars now, covering about 300-400 companies over the span of about 8 weeks, and we've been sharing a lot of new information that people have been looking for, and this is one thing that we really wanted to share today as kind of a takeaway. So let's look at this engine emissions breakdown slide, and this is through July 1st. So through July 1st of 2023, we had about 265 active frac spreads, put that in a range. And one thing we really kind of took away on the splits here is that we have a lot of aging equipment out there that's actually in the field working right now. And obviously with the transition to Tier 4 after 2011, we're seeing a lot more of those orders come in that are replacement orders, right? One-for-one orders, not adding to the capacity of the market. However, we wanted to share with you one thing here we thought was really interesting, that over 50% of the market is still conventional diesel, that yes, it can be converted into dual fuel, but it doesn't mean it's been converted yet, where it means potentially it's going to be converted. And when you convert it, you've got to take it out of the field. So, in a lot of cases here, operators are moving forward with using diesel as their primary fuel and getting the conventional rates, which are typically a bit cheaper. So something to consider here as the takeaway is that a lot of this Tier 2 equipment, which makes up basically 1 in 2 spreads in the market, is really old, between 13 and 18 years old. And these are things we're going to have to consider as we move through the next 5 years as this equipment starts to break down and potentially is only going to be replaced one-for-one. And again, not expanding the elasticity of the capacity of the market as we continue to look at the frac spread market go through consolidation and bring us down to that sweet 300 marketed frac spreads. But for now, this is what we see. We see the transition into Tier 4 and giving that DGB slash dual fuel a lot more breadth. And that seems to be the bridge offering for now, as electric fleets still represent a very small piece of the market. However, by the end of this year, we'll see a handful more spreads come in, push us towards 10%. But, to get us to that double-digit growth and really move us towards the newer electric technologies, we're really a few years out from that happening. So anyway, really some interesting information to take away here about the engine emission market out there and the frac spread market. And for us, our perspective, we're keeping really a close eye on this market that represents 50% of this equipment, represents equipment that is just really aging out there. And even with perfect maintenance, is eventually going to find its need to fail and going to have to be replaced one for one with newer Tier 4 equipment or potentially electric equipment. Moving ahead, we did want to share just a couple things. We have these, this is the second quarter of us doing these take threes. So let me explain what a take three is, and then we'll go over a handful of them here, which we thought were pretty important for the week ending here, July 21st. Basically, our take threes are a way for us to say, here's 3 important points that we kind of found in the earnings, just getting through it as quick as possible to kind of extract any important or imperative information. And each one of these points here you see from Liberty, Baker Hughes, and Halliburton are representative in our take three. So each one of these companies, we do a take three, which again, is just a short bullet point, 3 of them. And then about a week later, we'll do a really big deep dive, dig down into earnings, look at their, their forecasts and provide to you additional information. So let's move ahead here. So if you want to get more information on the take threes, you're going to get that at primaryvision.co. You have to sign up. It requires a premium subscription. We'll be doing about 13 companies this quarter again, and we're looking to expand as we move out throughout the year, but we're trying to hit on the key oilfield service companies with a focus on pressure pumpers. So one here was Liberty. Liberty is calling for a softness in the market. They say potentially there could be a 10% decline. They see that they can be pulling back potentially 1 to 3 spreads over the course of the next 3 months. Something to keep our eye on. Again, we are on the same page with Liberty here that we think that there could be. However, we're trying to be cautiously optimistic here that potentially we've moved through the recession and maybe have seen the low point. However, that's just, positive thinking at this point, because we could be headed towards a recession. We know that inflation is still sticky. We know that rates are still difficult. The capital markets are super tough. So with credit cards rising and all sorts of food insecurity increasing, we're keeping our eye on this. However, for now, we're on the same page as Liberty. And then moving ahead here into Baker Hughes, they're also calling for softness in the market. However, they had a monster quarter. You definitely want to dig deeper into Baker as they move their businesses into more renewable work, international work, and offshore activity, which is kind of their forte now as they moved away from, the pressure pumping market in the United States about 5-6 years ago. So Baker's also calling for softness. I think it's really key to take that word with a grain of salt, right? Like both obviously, leaders here chose that particular word. So at this point, softness could really mean kind of a handful of things, right? It could be soft landing. It could be meaning a handful of percentage points. However, they are looking at the completion market in the United States to be a little bit weaker than it has been over the course of the last year. And finally, one last takeaway here is going to be Halliburton. A really interesting thing we touched on in Q1, I touched on my webinars that we did last couple months, is this well construction business that Halliburton is growing. They just signed a pact with neighbors to accelerate the growth of this business. This is some really interesting stuff here that's not just going to add to the bottom line. It's actually going to add to the design. And these are things that are going to tie into the drilling rig. They're going to tie into the completion design and really help to add another layer of automation, another layer of accuracy and efficiency. And as Halliburton continues to show the way towards this manufacturing mode, which we've been waiting for years in the frac market. So really interesting stuff. Halliburton also said, hey, we're still in an upcycle, but they did see the 2.5% decline in revenue in the North American completions market, focused on the U.S. So, a little bit of good news there, a little bit of, okay, maybe we're seeing some weakness. again, all three of these seem to be a little bit, apprehensive to say, hey, we're headed towards tough times. They're kind of saying, hey, things might be a little bit tougher, so we'll keep our eye on that. And then, thanks for listening today. Again, Primary Vision on YouTube. We try to stay consistent with this, but, everybody's got busy schedules, and a lot of this stuff is free, and we like to market our products, and it's a busy time for vacations and craziness. So, on Monday, we have our Monday macro view, which kind of sets you up for the week. These are becoming really interesting, and Osama does a great job. Tuesdays, we're not going to have it next week, but we'll have it towards the end of the month with Greg and John. Excellent look at the equity markets, shale, OPEC, etc. Mark on Wednesday starts his EIA update, imports, exports, refined products. This is becoming more and more interesting, particularly as Russia starts to change their export role. On Thursday, the economy. This was really cool this week. You definitely want to jump into there and watch it. Mark talks about the exports declining or potentially being shut off, I think, for basmati rice in India. Combine that with the grain export issue between the Ukraine and Russia, and we could be headed towards some additional food insecurity layers. And then on Friday, we have our Frac spread count show, which again was free this week. So I hope you enjoyed it. Have a great weekend. Thanks for watching. Please share this and like and comment and do all those things so we can continue to share some of this information with you for free. We appreciate you watching. Once again, my name is Matt Johnson, Primary Vision Network CEO, and looking forward to touching base with you next week with all additional information on the frac market. Thanks again. Have a great weekend.